You can judge the quality of an idea by the quality of its detractors. Look, there's a reason Warren Buffett hates it. There's a reason Jamie Dimon hates it. They have to hate it, right? Horse and buggy people hated horseless carriages. Aaron,
Bro,
I got excommunicated.
there was such a regulatory risk with Bitcoin. It was like overnight this could be gone. Does Bitcoin eventually eat all other crypto? Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, welcome back to another pod. I think today, most investors are still kind of clinging to the old maps, that 60-40 kind of portfolio model. They still believe in long-term stability of fiats and the idea that, central banks will kind of always be able to steer us back to safety. But what if those beliefs, and I've been thinking about this a lot, at least a lot of them, no longer apply? What if we're living through somewhat of a regime shift where fiat trust starts to erode, technology rewrites our definition of money, and innovation is no longer just in Silicon Valley, but in the architecture of capital itself? Mark Yusko has spent his career navigating financial markets, navigating change in particularly, and from running endowments at Notre Dame and the UNC to founding Morgan Creek Capital, and even getting behind Bitcoin early when it was just $500. He's never shied away from kind of unconventional ideas long before they go mainstream. So I've listened to him for a few years now. I would say, as an onlooker, he's certainly part investor, perhaps even part philosopher, and someone who spent much of his life seemingly trying to figure out what comes next, which is what all great investors do. So today, we're going deep on where he thinks the world may be heading, why the old frameworks may be breaking, and how innovation might actually reshape global capital markets themselves. So Mark, welcome to the pod.
Aaron, I got to tell you, I've done a lot of podcasts. I mean, like a lot. That was the best intro. Not just because it was nice stuff about me. That was just a great intro about kind of history and philosophy. And so thank you for that. Thank you for setting such a incredible stage. We could talk for many, many hours about this, but
it's our pleasure. And thank you for coming on, Mark. I've been looking forward to this one. One thing that I really respect and really enjoy listening to you talk about markets and give some of your thesis is you kind of get ahead of these big shifts. You see things long before, I feel at least many others do, from alternative assets to digital networks and a lot of macro trends. Like that's obviously not easy. It's very, very hard to do. Just on a high level, what are some of your core principles that you've relied on over your investing career to kind of spot some of these bigger changes before they go mainstream?
It's interesting because I'm actually not a big, deep thinker. I don't like sit back and try to spot trends, but I have, just the math shows it, and over the time frame, I have been able to get out ahead of some things, and there's a couple common elements. So I think one is an appreciation, and it's just luck, right? I didn't plan to be an investor. I planned originally to be an architect of all things, very, focused on the lines and the details. I learned very quickly in one semester that was not me. I'm not a little picture person. I'm more of a synthesizer. So, flunked out of that, tried engineering, and that was good in the standpoint of, I think everyone should learn a little engineering because it's all about problem solving. And problem solving is everything we do in our life. But where I really lucked out was I ended up pre-med, which what does that even mean? Well, it means biology and chemistry. And now that I ended up in investing, what I've come to appreciate is that science, and particularly science training, and particularly the scientific method, I think is the perfect training for, as is philosophy too, but the perfect training for investing, because all of investing is about hypothesis formation, gathering data, testing the hypothesis, finding out where you're wrong and where you're right, and then reformulating a new hypothesis and testing again. And so I joke all the time that I've spent most of my career hanging out with the bad guys and gals, but the fringe people. And what do I mean by that? Well, I mean, if you go back to the early use of computing, right? When governments were the only one that had computers, the only other people that had computers were the criminals, right? And the government didn't want to share until mainframes came along in the 50s, and then the microchip in the 60s, and the personal computer. And so as we became more facile with getting access to information, I mean, you're too young to remember, but I remember we had this 26 volume, actually it was 28 volumes because you had an index and a glossary or something, volume encyclopedia in our house. And if you wanted to know something, you went and you got a book and you opened it up and you looked through it and you found. Now, the problem with all of that was, one, that data was so stale. Like, even though they updated every few years, it was stale. It was so biased because it was created by a group of people that, they couldn't fit all the information in the world in 26 volumes. So they took what they thought was important. History is written by the winners. So this is a really long answer to your question, but I think as information became ubiquitous, what I learned was two things. One, if you look at who's adopting innovation first, it's going to be the people who've been forbidden to participate in the mainstream stuff. Who is the first user of the internet? Porn, kind of. I mean, okay, how about cell phones and pagers? Drug dealers?
Drug dealers, yeah.
I mean, because why? Well, because if you were a drug dealer, they didn't want to hand you a regular phone, right? They wanted you outside the system. If you were a cannabis seller, even though when it became legal, you couldn't get a bank account. So you had to migrate to these other systems. So on the fringe is where the new technology starts because it's the only technology that's available to you. So I think that's one thing that I've been just lucky in my career to hang out with those fringe elements. One is kind of fun too. It is pretty lucrative. And the second thing is, as information became more ubiquitous, the skill, like when I grew up, it was you get trained, you study hard, you go to college, you get a degree, you be an accountant like my dad. You can never take too much accounting, which is true in the old days, because accounting was everything, particularly in finance. If you could do accounting better than other people, you could find out where the hidden assets were. But that was because information was scarce. Remember the movie Wall Street, the original, right? Yeah. With, Gordon Gekko. And how did Bud Fox win? He got information that other people couldn't get. Now, he stole some of it and he paid people for it and he would follow people around and see what plane they got on, because that was actually useful. I have a great story. There was a guy that I invested with. He was a hedge fund manager. He and his twin brother, both were hedge fund managers, and he was the first guy to buy Apple way ahead of everybody, like in single digits. And it's because when they had the iPod, the iPhone hadn't even been invented yet. So when they had the iPod, he was the first person to say, they're going to sell 1 million of these things. Well, how are they going to sell 1 million of these things? The street was like 250K or whatever. He says, well, I paid a bunch of college kids to go to the mall and ask the people at the store how many they were selling. I'm like, no way they're going to give you that information. He said, Mark, are you joking? You ask someone making minimum wage what they think? They'll give you everything. They were like pulling out the books and they're showing me. Said, I knew that they were going to sell 1 million units. And that wasn't insider trading. That was just good investigative journalism. Now it's against the rules because of regulation FD, as my friend in Boston calls it, regulation feckin' disaster. So, good Irish name. But if you go all the way back, information was controlled by the church. And you went to church once a week and you were told what to think, how to think, who to pay your taxes to, where to get your stuff, and you did all over again the next week. The printing press came along and busted the monopoly. Information became transferable. People could read. They were illiterate. Now they were becoming literate, and you could print books and pass them around. Well, what happened? Media became the infrastructure, and state-owned and state-sponsored. Like in America, we say, oh, we're not state-owned. Oh, yeah, go back in my day and watch ABC, NBC, CBS. They said the same thing at 6 o'clock every night. Walter Cronkite and Dan Rather, they said the same thing. They were given their talking points. That's propaganda, same as Russia or China or whatever. So we just think we're free. But that state monopoly got busted wide open by the internet. Information not only became ubiquitous, but it became two-directional. If you think about it, that Encyclopedia Britannica, encyclopediabritannica.com was the most valuable asset in the late 90s on the internet because it had the information, but now you could get to it. Now it was read only. You couldn't interact with it. Well, then the internet made information bi-directional. What does that mean? Like old days. I'm super old. I want to know what's happening in the Argentinian elections. I wait for someone in New York to send someone to BA, write a story, send it back. The editor edits, and she says, all right, fine. Page 17, if you're ingenious enough to get the newspaper and open to page 17, you could learn about the Argentinian election. Now, I want to know, is Milei going to win? I go to, Twitter. I'll never call it X. I go to Twitter. I watch a periscope of people standing in line in the rain for 2 hours chanting his name. Yeah. That guy's going to win. And so information became ubiquitous, and all the market cap that was at ABC, NBC, CBS ends up at Netflix and other network companies. So we went from read only, you could only read information from the internet, to then Web 2, read write, right? So now read write, well, what does that mean? Well, ripe old age of 61 a year ago, I just turned 62, I decided I'm gonna learn how to play guitar. And it's hard, by the way. It's hard.
It is.
But I'm learning. Now, did I go get a book? Did I go get a lesson? No. I went to YouTube and I found a bunch of people and I watched them do it. And it actually is amazing. And it's free. I mean, now I do pay to some of them because they're really good and I want to support them, but most of it's free. And so that read write, right? Now people post pictures or videos, and that content now is increasing the amount of information. So, all right, so I'm going to answer your question. So what makes a good investor? Well, it's in my pinned tweet on Twitter, right? The greatest wealth comes from investing in innovation. Investing in that means you have to invest in something that you believe in before most even understand. And you'll be mocked and ridiculed for that non-consensus action, but it's totally worth it. So there's a bunch of parts in there that are important. One is you have to truly believe in it. So you have to do work. You have to, form that hypothesis. You have to test that hypothesis. And my hypothesis testing was never like, I'm going to sit in a dark room and think of the next great thing. That's what I'll call a big E entrepreneur. I'm a little e entrepreneur. I like to look at new stuff and say, how's that going to make old stuff better, right? How is the internet? I mean, I remember 1996, I'm in South Bend, Indiana, working at Notre Dame. And we invested with this firm called Sequoia, which back then was not famous. Today it's famous and they're amazing. And they are amazing. And they were still pretty darn good back then, but they weren't amazing yet. Don Valentine was a legend, but Michael Moritz had never done even a deal yet. And so we invested, and they invested in a couple early companies, one Yahoo, and this little company called Google. And I remember my board at Notre Dame saying, that is the dumbest idea. That's a dumb name. Like, well, now it's a verb. And by the way, that is, and this is appropriate given we're recording this on the day that Jamie Dimon reversed his, it's a fraud. Okay, now you can. Right. So you can judge the quality of an idea by the quality of its detractors. Right? If people that you don't really care about don't like your idea, it may or may not be a good day. But if people you respect and admire don't like an idea, it probably has merit because they're worried about losing, right? They're being disrupted. And so my board at Notre Dame, they had donated a lot of money, their names on buildings all over the campus. They were like, this is stupid. And their point was, why would you invest in the 21st search engine? That was a logical question, right? There was WebCrawler and Alta Vista and Ask Jeeves. What do we need number 21 for? What they missed, and I didn't really understand at the time, they didn't invent a search engine. They invented a whole new way of accessing information. Here's an amazing stat. In 1991, there were 0 websites. Tim Berners-Lee came along, wrote 8,400 lines of code. Now we had 1. Today, and counting, I'm going to be off by a little bit, but there's about 1.7 billion websites. Google owns half of them. Whoa, what are you talking about? Well, here's how it works. Every time you type a question into the search bar, it takes you immediately to a website that already has all the answers, because lots of people have asked that question before. Now, if you happen to ask a unique question, which is really hard to do, it'll have to create a new website. And so they don't, think about it. If you type a question and had to search the internet for the information, it wouldn't work. So the original search engines, as they grew, got slower and slower and slower, and Google just kept getting better and better and better, because the more you do it, the more indexing you have, the better you are at it. So they invented something new. But I'll call that a little e invention, right? I mean, maybe some would call it a big E, but to me, it just made the idea of search better. And so, our little 500K turned into $200 million. And the light bulb just went off. It's like, wow, never done that before. What? And then I started really thinking about it. And what I realized was there was this cycle. And now I'm going to answer your question. So in our lifetime, we have seen a truly exponential increase in technology and quality of life, right? I mean, for thousands of years, maybe tens of thousands of years, humanoid forms struggled to survive. No grocery stores, they had to hunt, they had to, carry the fire around. And then it started to get better, and each innovation, whether that was the ability to create fire with a match, or whether it was the ability to harness the power of the sun or a neutron, whatever it was, each innovation made you a little better. And 100 years ago, there were almost no cars. Interestingly, most of them were electric. No one talks about that. And then Henry Ford and John D. Rockefeller basically buried that technology for 100 years to sell oil. Because here's the crazy story. John D. Rockefeller, had Standard Oil. Well, he didn't have Standard Oil like we think of oil. It was kerosene lamp oil.
Yeah, exactly.
We didn't have electricity. And so he had these kerosene lamps, and he would pull the oil out of the ground. He would strip out the kerosene, and he would flush the effluent into the river. So think about that. All that sludge from the oil would go into the river, and the river would catch on fire, which was kind of bad. And, Henry Ford comes along and says, I've got an idea. I designed a horseless carriage that wouldn't use battery technology. It's going to use grain alcohol. And John D. Rockefeller said, Hank, it burns, needs combustion. I got the stuff. Right? And it's free because it's coming out of my kerosene plant. So we'll use that. Forget growing corn and making ethanol. Okay, that was later. And the rest is history, right? In 1904, the biggest car company in America was the American Electric Vehicle Corp. And it took 100 plus years to get back. So technology tends to flow in cycles. And it's, again, history is written by the winners. It's usually determined by the people who control some form of innovation and benefit from it. So this cycle of progress started to accelerate. Computing came along, 1954. And I'm, again, luck, total luck. My life is this cycle. Now, I wasn't born in 1954, but my dad at the time was selling and installing mainframe computers. I came along in 1963. And 5 years later, there's an innovation in Silicon Valley around the microchip. And suddenly the center of the universe shifted from Boston, Massachusetts, where it was with Unisys and Burroughs and Digital Equipment Corp, to what is now Silicon Valley. And then I grew up in Seattle. So in 1982, there's an innovation around the personal computer. And Steve Ballmer's mom famously quipped, honey, why would you work for that company? No one ever wanted a computer in their house. Well, why did she say that? Because the Digital Equipment Corp CEO, remember, judged the quality of an idea by the quality of its detractors, said no one wanted a computer in their house. He has 18 billion reasons he was right, mom was wrong. Look, I grew up in Seattle. Many of my friends don't work anymore. They were smart enough to go to work for Microsoft. I didn't. Now I defend myself saying, if you look at the picture of the original Microsoft 11, you wouldn't work for them either. And they're multi-billionaires, I'm not, so I shouldn't make fun of them, but it's a funny picture. So 1996, we got the internet with Yahoo and eBay. Remember eBay? My board said, what are you going to do? Invest in a garage sale company? Not, okay, it is a garage sale company, but it's a big freaking garage. You know, if you got a garage on your street, not many people passing, not going to work. If you got a garage where anyone in the world can see it, yeah, better price discovery, better market. So if you take a piece of every transaction, that's a lot of money. So the internet came along. Then in 2010, now why is it always 14 years, Aaron? It's always 14 years. It's always 14 years because young people invent everything.
Right.
Because us old people, we're not going to invent something new. We're comfortable. We like what works. We don't want new stuff. Like my dad, 87 years old, doesn't have an ATM card. It's like, nah, I go to the bank.
Wow.
You go to the bank. Like physically, why would you go to the bank? Just use an ATM. No, that's not what. So old people aren't going to invent. So young people, you know, Mark Andreessen, 19 years old, Larry and Sergey in their 20s. I mean, just go through the list. I mean, Bill Gates, he looked like he was 11. And when you look at that picture of Microsoft, I mean, he was like 20 something, but he looked like he was 11. And young people don't know what they don't know. And so they invent stuff. And that's about half a generation. 14 years, about a half generation. And not every generation is motivated to, invent. And we've heard the fourth turning and all that, and it's all real.
Great book.
I mean, so that cycle, 2010, the mobile net. I actually remember being back in Seattle at Craig McCaw's family office. He was hosting a dinner. And Craig was a famous investor in the early days of cellular. He was giving them to all the drug dealers. I mean, not personally, but that's who he was. And I remember asking his family office guy, I think the mobile net is going to be as big a deal as the internet? He's like, Mark, are you joking? Ask people if they want a computer, like whatever. Ask them if they want a phone. They're like, well, I already got two. I probably don't need another one. Yeah, the mobile net. And my aha moment there, and to me, aha moments, if you act on aha moments, that's how you be a really good investor. So my aha moment for the mobile net was I was sitting at a traffic light in my town in Chapel Hill, just about 90 seconds, right? Sitting at a traffic light, and I went to Travelocity and I bought a plane ticket. I'm like, okay, I'm in. I'm all in. If I can buy a plane ticket in 90 seconds from my car, e-commerce is going to be a big deal. So, and there's a great video of Michael Saylor talking about this, and he actually wrote a book about this, about what today is FANG or the Mag 7 15 years ago, when they were $100 billion companies saying they were going to be $1 trillion companies someday. And people were like, what are you talking about? And he had, he had the 70s look of the hair and
shaggy hair. Yeah.
It's so, anyway. So I watched the one he did on Apple yesterday and it was amazing. He's like, look, they have 4 billion units. They have about a 4-year average life. That means they're going to sell 1 billion units a year. That's a big network. That's going to be valuable. So again, it wasn't really that hard. So anyway, fast forward to 2024, last year. I got the truth net. Now, what's the truth net? My other aha moment that matters, and then I'll stop talking, is, again, I observe. I mean, I read a lot. I surf a lot. I look at ideas. I listen a lot. And remember, in the information age, before the information age, it was about getting access to information. So if you were better at getting information, you were a great investor. Then there's a guy, Richard Driehaus, famous investor in Chicago, big, crazy hair, looked like the absent-minded professor, super successful. He was the first customer of a company called NewsEdge. So he was getting information on small cap stocks kind of before everybody. Again, not in an illegal way. This is actually pre-insider trading, but because he had the information before other people signed up to NewsEdge. And all of his stocks look like hockey sticks. Because remember, if you buy here and other people find out, they'll push the price up. And when they're small cap, they're illiquid. So he had an information advantage. Well, then what happened? Well, then everybody had NewsEdge and Bloomberg. Well, then what happened? Ken Griffin came along and said, I'm going to move my computers closer to the exchange so I can trade faster. So high frequency trading was born. And so then it became an analytical edge. So either you're a rocket scientist, like literally, and the thing I love about Jim Simons, totally iconoclastic, totally not what you would expect to be a quote unquote great investor. And someone asked him one day, he said, you have a model that uses the price of butter in Botswana. That has nothing to do with the S&P. He says, yeah, I know, but it's about 95% accurate in predicting the price movement. So I'm going to use it until it stops working. He's like, I don't give a shit what the data is. If the data has information I'm going to use it because that's my model. And so he had a processing or an analytical edge. Ken Griffin had a processing or analytical edge. Well, as computing became ubiquitous and everybody has a supercomputer, that edge is tougher to keep. There's still some that have it. Well, now I will argue it's a synthesis edge. So now investing is all about synthesis. There's tons of information. You got to be able to screen out, and this is maybe the most important trait of investing, knowing what's not important. Knowing what is important, that's hit or miss. You may get it, you may not. But knowing what to ignore, when you're like being bombarded with information, to know what to ignore so that you can be silent and think about things. Because one thing that we don't do enough of, particularly in the modern era, we don't think. Like literally, like take time, put your feet up on the desk and think. And if you know, someone could walk by and say you're loafing. No. That's working way harder. Little secret, right? Is the word eureka, right? When you have a great idea, you say the word eureka, and a lot of times it happens in the shower. Like literally, I have this great idea. Well, they've studied. Well, why is that? It's because you go to sleep. The last few things you're thinking about, your brain doesn't stop. It doesn't turn off. You don't die. I mean, you're just asleep. And your autonomic functions are functioning, and your brain's still working, your subconscious is still working. So a lot of times you'll wake up the next morning and that really tough problem. So if you, at the end of the day, first maybe give gratitude, that'll calm you down and get you to sleep. Absolutely. Second, talk about your goals, because then you'll actualize and move toward them. But then third, say, what are 2 or 3 things I want you to work on, supercomputer? And interestingly, this is funny. So we have a unique family. We have 2 older kids, 36 and 34, and then we have a caboose who's 14. So 20 years later, something happened, and we're blessed, and it's the greatest thing ever.
Awesome.
But my wife, we had 20 years off, and so at the end of the day, I'd come home, she'd hand me new child, and she's like, I'm going to go out for a couple hours. You were at work all day, so which is fair, totally fair. And with a baby, they don't do a lot. So I would sit on the floor with my baby, who I loved, but I had more big ideas in that kind of 9 months than I probably had the previous 20 years. Because I had forgot the process of taking time to just sit and think. Because I was busy. I was in the height of my career, and I'm blowing and going. And so that ability to think and again, take the stuff that's not important, focus on what is important, and actually really think about it. Anyway, so that's a really, really long answer to your question.
No, that's phenomenal. One of the things when I have 2 kids, and before when I was having my first, I was worried that, and this sounds very selfish, but I was worried that I would lose my risk tolerance because I had someone to take. I had to take care of.
Such a great insight. No, it's an amazing insight, and I can give you a couple examples where it is true. Yeah.
Yeah. Did you? I mean, you're definitely more of a conservative investor, but you do take risk. Did you have a similar
100%
situation?
So I was classically trained. To your point, right? I went to University of Chicago. I studied under Dr. Markowitz. The king of modern portfolio theory, where you start with cash and you add bonds, and that lowers risk. And you add stocks, that lowers risk, and then you add private equity. So you add new things that in and of themselves are very risky or volatile, but you add them to a portfolio, so your whole portfolio gets less risky. So you start with the 60-40, but then you add 20% in private and alternatives, although I hate that term. I would say alternative to what? People don't like alternatives. Right. Alternative music, alternative education, they don't like it. So they put a little bit in when really, what's alternative about it? What does a hedge fund do? They buy stocks, bonds, currencies, commodities. Those are the 4 things you can own in the whole world. Stocks, bonds, currencies, commodities. Private equity, common stock, preferred stock, convertible bond. Real estate, commodity, the land, equity of the deal, debt of the deal. Arbitrage funds, common stock, preferred stock, convertible bonds, currencies. I mean, it's stocks, bonds, currencies, commodities. That's all there is. The fifth asset is innovation, because innovation leads to those other things. Without a new innovation, without a new technology, you don't get new companies, which means you don't get more stocks, bonds, currencies, commodities. So to your point, I wish I interrupted you, and I'll let you finish.
No.
You felt that you were going to lose this risk tolerance. Why did you feel that? And then I'll answer. Then I'll give my point.
You have this new human that you've created that's relying on you.
Yeah.
And you've lived a life where it was either just you or maybe just you and your wife. And it's, you can afford to take those risks. But when you have a child relying on you, you're like, whoa, this is serious. And then you have two and perhaps more. And it's like, I was so worried. I just remember, my eldest is 12 now, but I just remember, I was like, I wonder how all these investors do it. These guys who rely on their decisions, their ability to make an assessment, which can be right or wrong and it's risky. Yeah. I wonder how they continue to take those risks when they start to have a family and so on. And that was my biggest paranoia.
It's such a great insight, and I love it. And there's the positive element of it, which is just acknowledging that the world has changed. Your world has changed. Their world, because they are dependent on you. And there's an interesting thing about, like say, being a speculator or being someone who can tolerate volatility. Most people don't like volatility. They don't like the word volatility. All volatility is disagreement about a future state. If there's no disagreement, there's no volatility. You buy a T-bill, in 90 days, you're going to get paid. The government's never defaulted. That doesn't mean they won't default, but they've never defaulted. So you have pretty certain, so you have zero volatility. But here's the thing. If you bought a portfolio of all treasuries, T-bills, you would lose in the big game because inflation would chew up all your returns. Yeah. So you'd get less rich every single day. It's the worst strategy, and that's what Markowitz proved. He said you start with cash and you add bonds, which have an element of risk because a bond can default, right? A company can do poorly. And if you add high-risk bonds, it's even more risky. But when you add them to a portfolio where they're uncorrelated, this is the key, when they zig, when the other zags, the risk of the portfolio goes down. So you think about it, okay, I'm a speculator. I tolerate volatility. I can handle the ups and downs because I know I'm strong and I'm good and I'm going to do better the next day. But now if I got to put food on the table and roof over the head of the kids and pay for college and all that good stuff, okay, well, a couple ways you can approach that. One is you can change the portfolio from far right tail risk seeking volatility maximization, which long term, if you have any skill at all, long term, that will provide a much higher return. It's like Stanley Druckenmiller says all the time. In the early days of hedge funds, those rich people wanted 15, 20, 25% returns. They didn't want 6% with no vol. It's not interesting. So, but you have to take the vol to get the better return. Well, so a couple things you can do. One, you can start to shift a little bit toward the mean. You can add a few diversifying assets. I think the better strategy is to take a little bit out and have the run-in money, right? Or and the reason I was chuckling a little bit is I used to get in debates with people on this. In my first iteration, I was an allocator. I said I had the best job in the world. I got paid to talk to the smartest investors in the world, like Nobel laureates and people you read about every day and firms that you die to get into today. And that was my job. And then I got to decide to give them money to make my money go up, or my institution's money, it wasn't my money, the institution's money go up. Like that $200 million, that wasn't mine, that was Notre Dame's. There should be a quad at Notre Dame called the Google Quad. But the thing about it is that there's a theory that a manager should have all their net worth in their strategy to be fully aligned with client. And when you have a little bit of money, all of it. When you start getting more, nope. Because now your risk tolerance, Mr. Portfolio Manager, is going down because that's a lot of money that's yours that you could lose. So in the early days, you're playing with house money or other people's money. You're taking a fee if you make returns, right? If you do better than the average, then you get incentive fee. So what would happen inevitably is as these rich guys became richer, you look at it was this, perfect, X, okay? Assets under management, alpha. Yeah. Size is the enemy of returns. And so the experience is, it wasn't that your assets under management was growing, it was your responsibilities were growing. And so it's a natural inclination to say, oh, I need to change. Now, I said, to me, the better way is the barbell it, is stick to doing what you're good at, but then take a little bit over here in the super safe that'll pay the bills.
Right.
I'll give a good example. So everyone thinks that Yale is the best performing fund. And they're really good. And David Swenson, God rest his soul, was one of the best ever to do the game. But they're actually the third best. Now, that's pretty good. Third is good.
Right.
And why were they so good? Well, they were 60-40, but they weren't. They were 80-20, but they weren't. They were really 90-10, and that 10 was barely bonds. It was more absolute return strategies. But the 90 that was equity wasn't stocks. It was private equity and real estate equity and commodity equity and venture capital, 23% venture capital. Because venture capital is the best performing asset long term. Has high volatility, and you have a lot of zeros, but the winners more than make up because of the power law for the losses. Well, they had 23%, and they were the third best performing fund. The second best performing fund was Jeremy Grantham's foundation, which had 40%. Think about that. Put 40% in venture capital. People were like, you're a fiduciary. You can't do that. It's like, what are you talking about? I'm going to spend 5% every year. So I got 15% over here in cash to pay 3 years of spending. And the rest, I need to grow. So I'm going to put it in the best asset. It's like I argue all the time. 401ks, they're such a scam. They tell people to be afraid, and then they put in stocks and bonds and charge high fees. What they should be, it should actually be against the law to be in bonds in your 401k. Literally, it should be against the law. You should have to be in real estate and venture and all the things that are wealth creating through innovation. But the number one performing fund over that 20-year period was this little company called the Dietrich Trust. And Bill Dietrich, before he passed from cancer, again, God rest his soul, said, look, I believe in, I don't know if Buffett actually said this, it always gets attributed to Buffett, but said, investment committee should be an odd number and 3 is too many. So yeah, I'm the investment committee. And the reason for that is groups don't make good decisions, right? Do this at a party sometime. Ask a group of people the best restaurant in town. And you will get McDonald's. No, that is not possible. I know you like Indian food, and I know you like Pakistani food, and I know you like Mexican food. Give me... Oh, no one wants to say, oh, I like this crazy Indian place, or oh, I like this crazy. No, they're like Continental, just go to McDonald's. So groups are going to dumb it down so they don't get kicked out of the group. Because if you're in a group, you want to stay in the group. And so investment committees will dumb it down to the least, they'll go to 60-40 because that is the lowest volatility. I'm like, but that's dumb. That's not your enemy. Your enemy is inflation, ravaging your purchasing power. So I admire Bill because he said, I'm going to put 15% in cash to pay 3 years of spending, 85% in private, and most of it in venture. And even though his volatility was higher, he outperformed everybody by a lot. And so so that's how we got to where we are today with digital assets and Bitcoin. So you didn't ask me this question, but I'll answer it anyway. In that, I've just been blessed and I've lived a life of happy accidents. And so I have a good friend, Dan Moorhead, Pantera, famous investor. And Dan and I have been friends for 30 plus years. He was a Goldman and he went to Tiger, and I had a special relationship with Tiger. And I seeded everyone who ever left Tiger, pretty much we gave money to, from Chase Coleman to everybody. And when Dan left to form,
why'd you do that? You just knew they were talented?
Yeah. So yes. So there's actually a shameless plug. There's a book written by Kathy Burton called Hedge Hunters. The first chapter is me. I didn't write it. I spoke it to her. It was an interview. And she asked me, she said, well, how do you, because remember, I had the best job in the world. I got paid to go around the world and evaluate talent. That was my job. And
pretty cool.
If you do it enough, one, you make a lot of mistakes. And if you survive, then you get better because you learn from the mistakes. Remember, the thing about mistakes is Ralph. Recognize, admit, learn, forget. That's from Dean Smith, famous coach. And then again, the other thing is what Coach K, that other guy down the road, said, which is what separates a great player from an average player. And this applies to investing too. The average investor or the average player totally focused on the last play. The great investor, great basketball player, anything, always focused on the next play. Like Michael Jordan says, I've taken 19,648 shots that I missed. I don't remember taking any of them. Because a bad player, an average player, misses a shot, go down and commits a stupid foul. You've seen it hundreds of times, right? A great player misses a shot, doesn't even remember taking it, goes back, plays a good defense, steals the ball, makes a layup. A great investor loses money. They're obsessed. Oh my God, I lost money. I don't want to do that again. A great investor is like, it's past. What's the next play? So you got to focus on the next play. So why did I allocate to all these people who worked for Julian? Well, I got lucky. I moved to North Carolina, take the job down here. Julian was the largest position that I inherited. So I got to go up and talk to him a lot, and we became friendly, and he kind of adopted me a little bit and became a mentor, and it was amazing. In fact, when I left North Carolina, I got an email, said, say it ain't so, like Shoeless Joe Jackson. Julian. I joke, I don't get a lot of emails from billionaires. I was actually my first one, and got on a plane, went to New York, and I actually thought I was going to get my Nike shoe deal, right? I was leaving the university. I was a low-paid employee, because the coach makes $4 million, but he makes $200K from the university, and then Nike and TV and all that stuff pays the rest. And I thought he was going to try to convince me to stay, arrogantly. Yeah, and I thought he was going to, say, oh, we'll figure it out. No, he came out and he said, look, I'm surprised you lasted this long, honestly. I like you all and work together. So I hit that bid, and he helped get us started. But what he taught me, and what I talk about in Hedge Hunters, is there are certain things that you look for. And interestingly, just very interesting, because it just happened last night. So my 14-year-old plays lacrosse, and 3 years ago, he had this coach on his sixth grade lacrosse team that had never coached lacrosse, right? Just said, I'm going to do it because I love the kids and I want to do it. And I think this can be a disaster. And it was the greatest. This guy was the most positive person. I mean, they were still bad, but this year they almost made the playoffs. So in 3 years, they were incredible to watch. But that first year, they could beat every game. But his attitude with the boys on being positive, and like at the end of the game, they would cheer each player, and it was all about, be strong, right? No matter how much adversity, just be strong and get through it. And so he talked about the 4 C's, right? About consistency and competence and character and courage. It's exactly what Julian taught me, right? The most important thing in investing, competitiveness, the need to win and not lose, but more to win. In fact, that's a big difference in investing. Most people are so afraid of losing that they never win.
True.
Right? In fact, there's the famous picture of Paul Tudor Jones in his dorm room at Virginia with the loser's average loser sign behind him. Because everybody's like, oh, I bought something, it went down. Oh, I got to show that I'm right and the market's wrong. I'm going to buy more. No, cut your losses and move on. What you want to do is winners press their winners. And this is the thing Julian taught me that I can never repay enough. And he didn't teach it to me directly. I learned it every time someone would leave, we'd back them. And then I would go interview them. And I have these pages and pages of notebooks. I should probably write a book about it. But I asked people, what made Julian so great? And everyone would always say he was a man of integrity. Like, here's a guy, he went through customs one time wearing a pair of shoes that he bought, and he sent a check the next day. Like, who does that? Most people lie about what they did or didn't buy. He cut a check because he was a man of integrity. So integrity was number one. But they said he had this amazing ability to have courage, primarily because he said, never fudge the numbers. Like, he would say, well, what do the numbers say? And someone would say, I think. He said, I didn't ask you what you think. I don't know what you think. I don't want to know what you think. Tell me what the numbers say. And don't fudge it. If you don't know, go back and get the data and come back to me. So he always had courage of his convictions because he had done the work. So doing the homework was important. But the thing that people said that he did better than anyone was he could press the winners. He would double up. He would never double down, like never, ever. And he would always, and doubling up, it's by far, because it's against what Harry Markowitz taught us, right? You're supposed to rebalance every quarter, and you're supposed to sell your winners and rotate to your losers. Now, in a portfolio across asset classes, I kind of agree with that. But when it comes to winning strategies and winning companies, pressing winners, it really works. But it's so hard to do. So that consistency, character, courage, conviction. I mean, all of the C words come into, and I talk about that. And the last one is competitiveness, right? Julian hated to lose. I mean, like that's an understatement. It's like Michael Jordan-esque. I don't know if you've ever seen the picture of Michael Jordan playing defense on Magic. The look in his eyes. Like, I want that one time in my life. Like, I want that level of intensity one time in my life. And if you aspire to it and try for it, and you get 80% or 90%, that's good enough. But, because 100 is probably hard. But that competitiveness is so important in everything. So, to circle this all back, Dan was my friend. And in 2013, he calls me up and says, hey, come to San Francisco. Buy dinner. I'm like, great. I have dinner with my friend. And I go out there and he says, I'm giving all the money back. I'm like, Dan, why would you give back $1 billion at 2 and 20? He says, I'm going to spend the rest of my career in Bitcoin and blockchain. And look, in 2013, I was not running drugs on Silk Road. I'm pretty nerdy. I was not a cryptography student. Bitcoin, I'd heard of it, but I didn't really understand it. But blockchain I got because I had the aha moment that blockchains are an operating system, right? Mainframes run on COBOL and Fortran. Microcomputers ran on Unisys and Spark. Personal computers run on Windows and DOS. The internet runs on TCP/IP. We're using it right now. These things run on iOS and Android. When Google bought Android, people laughed at them. Now they have 80% market share. 80.
Crazy.
19% is Apple and 1% is other, but 80, because operating systems matter. And so the mobile net runs on iOS and Android, but the truth net runs on blockchains. So I kind of got blockchain. So I gave him some money for his blockchain fund, and that fund's up, it's like 11, 12 times. That's great. Yeah. Should have put money in the Bitcoin fund. That's up 300 times. But maybe it's even 350 times. But the key is that I didn't. But I did start to do work. And my aha moment was that I actually wrote about this. It's called the digital gold rush. When I realized that this technology was the evolution of money, right? There's only been one money in the history of mankind, and that's gold. We said, no, there's lots of monies. No, those are currencies. I agree. Currencies are different than money. Money is an asset that exists in the absence of a liability. Now, you can argue that there were puka shells and stone wheels. Right. Yes, there were. But for 5,000 years, the only one that survived, well, that's not. Silver, kind of, but gold, sort of. Definitely. And it's an asset that exists in the absence of a liability. And the only way to get it is work. I love this part. You have to get it out of the ground. And along comes digital gold, Bitcoin. Now, why is that important? Well, gold is awesome. And like I always joke, if I were Kyle Bass, which I'm not, and he's a friend, and you go to Kyle, he would reach down under his desk and he would pull out a 26 kilogram gold coin from Australia. Like literally, I mean, it's like this giant pop. Now, even if I had that under my desk, which I don't, and I wanted to break it in half and send you half, I mean, one, I'm not strong enough to break it in half. Two, I couldn't stuff it in the computer and send it to you. But with Bitcoin, well, a couple key taps, I can send you any amount down to 1/100 millionth of a Bitcoin, one Satoshi. And that means it's more divisible and more portable, but it's equally scarce and equally hard because it's proof of work. And those things, I think, make it the future of money. And that once I had that aha moment, I couldn't unsee it. So in 2018, I formed Morgan Creek Digital, much to the chagrin of my partners who thought I'd lost it. And they're again, why are you going to go hang out with the drug dealers and terrorists? I'm like, well, yeah. I'm not going to hang out with them, but I'm going to hang out with the people driving the technology that, yes, the people on the fringe are going to be the first to use, but ultimately we're all going to use. And, I'm wearing my orange, I'm wearing my Bitcoin socks from Mount Socks, because I do that every day because I'm all in. I believe in this so much. I mean, you can see the orange planter back there. Yeah, everything in my life is orange now. So, because I remember back in 2013, 2014, people talking about Bitcoin. I mean, even a little bit before that, it was like you were not considered a serious capital markets pro. I got excommunicated.
I'm not
to use my good
surprised.
Catholic. No, I'm serious. I was excommunicated from my, friend group in the
Crazy.
endowment and foundation space. They're like, this guy's lost it. I wrote a letter in March of 2014.
Yeah.
I'd been studying for about 9 months, and I wrote a letter, and like I said, the price was $500. And I said, this is an interesting, special situation. This is a 41-page letter. I always wrote these long letters, and people say, why do you read them? No one reads them. I said, they're not for them. They're for me. If I don't know what I wrote, how do I know what I think? So I write for me, and if you want to read it, great. I mean, not you personally, but anyone wants to read it, great. And so my PR person, no one's going to read that. I'm like, it's okay. I read it, and that's what matters. So, but I wrote this letter, and my clients did read it, and they picked that one paragraph out of 41 pages and said, you're an idiot. We will fire you. Go back and do your job. Wow. Now I chuckle. The next paragraph was about Saudi stocks, which I will argue is more objectionable than Bitcoin, given what happened over there. But anyway, no one complained about Saudi stocks, but they complained about Bitcoin. So I'm like, now the price went from 500 to 186 or 187 by September. I'm like, you know what? They were right. Went back doing my job. 8 weeks later, it was $1,000. I'm like, no. There's something here. Did more work. Again, proof of work. I did more work, and it clicked. And that was in the early part of 15 when my son was graduating. I tell the story. He hates it, but it's true. I said one word, not plastics, like the graduate said blockchain. Go talk to Dan, get a job at Coinbase. We were early investors. It'd be great. He goes out. He's like, he's wanted to live in San Francisco his whole life. And so I don't know, Dad, maybe it's going to be a big deal, but I'm just going to go to KPMG. Safe, gets me to San Francisco. I said, you're going to hate it, which he did. Quit after 9 months with no job, which is a millennial thing. They quit with no job because they're not happy. Yeah. Like, no, you get another job, then quit. That's not the way it works with millennials. No. But, and God love it. Look, my son is amazing. He ended up taking a job. That company got acquired by Adobe. Then his old boss pulled him over to a company called Snowflake, which had just a rocket ship. And now he's thinking about what he wants to do. So I'm very proud of him. But he did call me up when Coinbase went public and said, Dad, you're not as smart as you think you are. I mean, no, he did say, you were right, which I appreciated, but you're not as smart as you think you are. I'm like, oh, do tell. I told you to work at Coinbase. He says, yeah, but you didn't lever up the house and put all in Bitcoin. I'm like, you are right. I did not. The reason I didn't have the conviction, one, I was old. Two, I had the safety. I had the kid, right? I had the clients. I had the responsibilities. And, I can't mess that up. I had my partners telling me, no, we will not support this. And I'm not making fun of them because it worked out. I'm telling it as it was. It was risky at the time to believe in something that people didn't understand.
And there was also the this is why I thought like your call, because I read about this, I thought the call took a lot of guts, right? Because back in 13, 14, 15, all the way up till, probably 4 years ago, even less maybe, there was such a regulatory risk with Bitcoin. It was like overnight, this could be gone. That's what kept me out of it until 2 years ago.
Aaron, and again, my wife would just say, Mark, you're so damn naive. So literally, the day after we announced the formation of Morgan Creek Digital, got a call from the SEC.
Yeah.
Not exaggerating. The day after. And they were on us like white on rice. We hadn't even done anything yet. We had just said, we're going to do this. We're going to raise a fund. Now, I will give them credit. The reason they came in was not to bust our ass. Because this was the regional group. This wasn't the people in Washington who were politicking. They said, we need to learn. And they didn't say it as clearly as that. But they were much more about, hey, show us all this, teach us. Yeah. And that was cool. And then it happened again 3 years later, and it was a little even more kind of, okay, we really need to help understand what's happening here. Right. So I admire that, right? If you don't understand something, seek people who do.
Yeah.
And they had the ability, they can call anytime they want and come in. And so, but when Gensler was in charge, the tone did change. All of that goes to your point. It was a time that was fraught with peril. Now, I was lucky or unlucky. I mean, luckily, I started down the path before Gensler. I had to endure the Gensler era. And now everything's switched to tailwind because the new guy is fantastic. And Trump and Team Trump and Eric and all those others are behind it. But
to Gensler's credit, though, he did get the ETFs. He did get ETFs approved for Bitcoin. And I think that was a big moment.
But I think, to your point, he allowed them to happen because the big boss spoke. And I tweeted about this on June 4th of whatever year that was, 2023, when BlackRock said, we're going to apply, like it's done. There will be ETFs now. Yeah. Up to that point, no way they were going to approve them. When the Winklevoss applied, no way. When Bitwise applied, no way. As soon as BlackRock applied, it was done. It was a done deal. Point. And so I think he was coerced into saying, okay, BlackRock says, show me the money. And there's lots of conspiracy theories about why BlackRock wants to be involved, and they're gonna suck up all the Bitcoin, then they're gonna control the network. Like, well, that's not the way it works. They're not running the nodes, but okay. And even if they sucked up all the Bitcoin, and they, Max, and I love Max and Stacy. I mean, I love them. And Max talks about, it's a conspiracy. They're gonna seize them. Like, here's the deal. It's certainly possible that could happen, right? That they could say, you know what? By executive decree, we're gonna seize everyone's Bitcoin. Now, the problem with that is you'd be seizing it not from the bad guys and the criminals, but from widows and orphans and pensioners and But okay, you could still do it. But here's the thing: unless they get 100%, and I literally mean 100%, not 99.9, not 99.99, 100. Unless you get 100%, all the value stays in the chain, and that's what keeps me sane about it, because Satoshi even talked about this. He said, yes, coins are going to be lost or stolen. There's not going to be 21 million. That's all that will ever be mined, but we're not going to have 21 million. That's why it's divisible, because there's trillions of Satoshis. I mean, actually quadrillion, 2.1 quadrillion. So the key is that, yes, stuff's going to get lost or stolen. Maybe the Nakamoto million never show up. Maybe the government does see some. I don't know, but it doesn't matter. He said it, because remember, it used to be he, she, they, but then he self-identified once as a he, so we know it's a he, or some number of he's, but there is at least one he. And he said, consider it a donation to the community. If you lose your keys, and it's so elegant because we've all lost money, right? We've all lost cash, or we've had a bank account we forget about it. But that's different because they just print more. The problem with fiat is, like, there are stories where they open up a house and they see all the cash buried in the wall. No one missed that cash because they just printed more. But we know how many Bitcoins are because we have a permanent, immutable truth. And the aha moment for me was 838, now 839 years, we've had a trust system. Banking is built on trust. You give your money to a bank because it's not safe to hold it all yourself and carry it around. So you trust them. But I actually have a recurring nightmare, not like every day, but maybe once a year. Go to the bank and punch in my code, because I do have an ATM card, and it says $0. How would I prove it's not zero? I don't have a statement. I haven't had a statement for years. Is their word against mine? Now, I could probably prove, because of old receipts or something, that I used to have money and now they say I don't. But it would be their word against mine. So that trust actually is a great system. I know people piss on it and they say, oh, it's terrible. I'm like, without it, we'd have still a pretty crappy life. I will argue fractional reserve banking is what created progress as we know it, but okay. But do I like be my own bank better? Yeah. Is it going to happen overnight? No. So until such time that we get there, there's going to be this interim piece of CeFi, and I think Coinbase is doing a great job and others doing a great job. But ultimately, do we all go DeFi? And is it, someone said this morning, every financial transaction in the future will be AI to AI, no humans.
Right.
Yeah. You know what? A simple example. You get in your car today, you pull up the gas station, you get out, you pump the gas, you take a plastic card and you tap. Are you kidding me? In the future, You won't get out of the back seat, not the front seat. The car will fast charge, and the car will pay the machine, and you'll drive away. And that's better. Or you get into traffic, and you want to go in the fast lane. Okay, now takes a picture of your license plate, sends you a bill, and you write a check. Oh my God. No, the car will pay the lane. And so, yes, those AIs will certainly interact, but do I think no human activity will be there? Will there be no human speculators? I doubt it, but maybe.
I got two more things that I really want to address, and I know you're busy, and I know we've been chatting for a while, but
I told you we could go. I talk too much.
No, it's great. I love it. I love it. It's great. There's one. So I own Bitcoin. I'm a believer. My conviction level is, I don't think, nearly as strong as yours. I'm in it for the price, to be frank, for now. But one thing that has held me, I just find very kind of odd about Bitcoin is Satoshi. It's like, okay, there's this guy who made this beautifully elegant invention that could one day be new money, right?
Yeah.
Digital gold, so to speak. Nobody knows who he is.
Yeah.
This seems a bit crazy to me. Like, this has to be deeper than one man. It has to be bigger than one man. Don't you think?
So, I mean, it's totally logical, and I've had the same thought. I've actually done real work on this from the very beginning. So when it first
I figured you
suggested to me, I went to the source, the internet, and I typed in, who's Satoshi Nakamoto? Curiously, what comes up is Intelligence Central. The name Satoshi means intelligence. Nakamoto is the name of families from the central provinces of Japan. Like, that's curiously close to CIA.
Yeah, yeah.
Okay. So then you dig a little further. Curiously, in 2006 or 7, I can't remember the exact year, I think it was 7, there is a paper sponsored by the NSA, written by Satoshi Sakamoto. You can look this up, like, it's true, Satoshi Sakamoto, who was the chief technology officer at NTT in Japan, and it talked about a peer-to-peer cash system. Curious, interesting, okay, interesting. So I dug deeper. I'm like, all right, if you were in charge of the global reserve currency and you saw the writing on the wall that was going to go away and the only end game was devaluation, and what I mean by that is once you get into debt, you have 4 options. You can pay it back. Okay. You can restructure it, you can default on it, or you can devalue it. Can't pay it back. Like, you could seize all the assets of every human in America, you couldn't pay the debt. Not just their income, but all their assets. You couldn't pay the debt. So paying it back, off the table. You can restructure it, like gives people 50 cents on the dollar,
right.
But someone's got to take the other side. Not many takers for that, but you could try. You could default. Politicians, what happens if you default? You're out. Politicians don't like to be out. I joke all the time, there's no left, there's no right, there's no Republicans, Democrats, there's in and out. When you're in, you do or say whatever it takes to stay in, and when you're out, you do or say whatever it takes to get in. I mean, think about it. Ronald Reagan, not a Republican. He was a lifelong Democrat. He's like, I want in. I'm going to be a Republican. Donald Trump, same thing. I mean, it's in and out. So they're not going to default on it because they don't want to be out. So you're going to devalue it, debase. And that's been the history. Look, there have been 775 paper currencies in the history of the world. 3/4 no longer exist. They all went to zero. All the others are going to zero. Look, the pound sterling, it's called a pound sterling. It's the oldest currency still surviving. It's like 326 years old, something like that. It used to be, for a note, you got a pound of sterling silver. Today, it's like 194 pounds. So it's just been devalued to, cents on the dollar or fractions of a cent on the dollar. So the key here is it possible that, the other one is if you look at Satoshi Nakamoto, Sa comes from Samsung, Toshi comes from Toshiba, Nakamichi, and Motorola. So you could say it was a bunch of tech companies, but I don't believe that one. But the Central Intelligence Agency makes sense to me. Why? Because if I'm the world reserve currency and I see the writing on the wall, what if I got everybody to swap the worthless fiat into this cool asset, and then I seized it all out the back door? Now, we're, again, super lucky. We, by happenstance, we have 3 general partners, and then we have a venture partner, and our venture partner is Scott Stornetta. If you read the white paper in the back, there are 8 footnotes, 3 of them, Scott and his partner, Stuart Haber. Scott coined the term blockchain. He and Stuart, this is great. They said, if I lend you money, Aaron, we need a judge to make sure that we keep our ledgers the same, okay? But the problem is, if Mark's unscrupulous, he could bribe the judge to change the number. So we need a judge to judge the judge. Well, then he could bribe both people. So we need a judge to judge the judge. He says, well, we need everyone in history. That's a blockchain. So he was brilliant, Stanford. And so he's got 3, white paper notes. And so I asked him, I said, what do you think of this? He said, interesting theory. Nope. I'm like, Scott, come on. You didn't even think about it. He says, well, no, I did. But the way you're thinking about a backdoor is impossible with Bitcoin because of the air gap. I'm like, but then as soon as he said, but with Ethereum, you could have a backdoor. Whole nother story for another day. But that was really interesting. So is it possible it was NSA or CCP? Sure. I don't think it was CCP because CCP is going down their own digital currency. Look, digital currencies, government digital currencies are evil incarnate, right? I mean, programmable money. I mean, all you got to do is watch Augustin Carstens for even a minute 47, Jabba the Hutt or Kingpin. I mean, not good, right? Of course, we should have the power to control how you spend your money. No, you shouldn't. So is it possible it was, Satoshi Sakamoto and NTT and the NSA? Sure. Is it likely that it was one person? No.
Yeah.
Do I believe it was 4 people? Maybe, one who passed away, another one who's in jail, and that's why, multi-sig and you can't move. Is it Craig Wright? Hell to the no. But I don't think it matters in that the beauty of the system is that it is anonymous. Like if there was a CEO or if it was a company, that company can be coerced, right? Why does Google get to read all of our messages? Because they were coerced, right? The government showed up one day and said, if you want to be the biggest, you will truncate your fiber. One closet for you, one closet for us. Like, really? I mean, like, all our data you get to see for, what do we get out of that? You get to exist. That's a real story. That's real. Yeah. So is it possible? For sure. I mean, the NSA created SHA-256, right? So, or CIA, one of the two. So certainly possible. But I don't think it matters because once you unleash this system into the world, it's an adaptive biological system. The miracle was it got to $1.
Interesting.
1 to 100, not a miracle. 100 to 1,000, not a miracle. 1,000 to 10,000, not a miracle. The miracle was that anybody used it at all. Tomorrow is Bitcoin Pizza Day. We're going to celebrate. I should remember his name because he is a really, really important person in our history because he proved that you could use this.
Bought a pizza with it, right?
Yeah, and he bought 2 pieces for $10,000, which is over $1 billion. And everyone's like, "Oh, you're such an idiot." No, he's a mad genius because he proved that this worked. And so the key is that once you release an adaptive biological system and it survives, it thrives and it morphs. And one of the things I love about the debates, everybody's like, Jamie Dimon says, well, Satoshi could show up tomorrow and change the code. And Jameson, I love Jameson. He's like, no, Jamie, here's the lines. And it's only 7 lines. But in order for that to change, more than 50% of the nodes would have to agree. Now, that can happen. That's a complex adaptive system. But one guy can't show up and change that. It's not the way it works. And so it's such a beautiful and elegant system. It actually defies logic to think that one person could have got it all right. Like, think about this. The 51% attack will never happen. How do you engineer that as a single human being? How could you come up with this game theory to say there'll never be a 51% attack because the moment you achieve the 51% attack, the value would go to 0 because all the other nodes wouldn't acknowledge what you just stole. So there'll never be a 51%. It wouldn't make sense to spend all those resources to do a 51% attack. Like, oh my God, that's mad genius. So it doesn't seem logical that could be one person, that one person could be that smart, but maybe. But I'm at this point, I don't care because it survived. And all good ideas that become great ideas do this. Paul Romer won the Nobel Prize 5-6 years ago. And I've been a Paul Romer fan, this is crazy, since 1986.
Wow.
So in business school, I read Paul Romer's paper, The Law of Increasing Returns. And I said, my God, this guy's going to win the Nobel Prize someday. Now, it took a freaking long time for him to win the Nobel Prize, but he finally did. And it's because it's such a simple idea. He says, it's not the best technology that wins. It's the technology that gets critical mass first. And we can all think of lots of examples.
Oh, yeah.
Right? Where there was a much better way to do something or a much better technology, but it didn't have the right marketing department, or they weren't invented in the right place, or, if you're invented in Papua New Guinea and you don't get off the island, it's kind of hard to propagate around the world. And so it's a really interesting dynamic that this complex adaptive system that is Bitcoin, it is a better money. It is the evolution of money. And it's funny. So I'm wildly bullish, and I think that, we displaced gold as the core of money. And the monetary value of gold is about 10 trillion. So 10 trillion, and let's say there's, just around numbers, 20 million Bitcoin, you're talking about, a meaningful price for the price of Bitcoin.
That's what I wanted to ask you about was I didn't mean to cut you off, Mark, but I know you have a lot of thoughts on fair value of Bitcoin as well. And I didn't mean to cut you off, but I want to get into that.
The ultimate value is the monetary value of gold, 10 trillion. Okay. But that's not fair value. Fair value is determined by Metcalfe's law, and Tim Peterson has the best model on this. And it has to do with the number of nodes, the number of users, number of wallets, number of transactions. And that today is around 100-ish thousand, 95 to 105, somewhere in that range. It's kind of tough to pin down. And that will continue to accrete over time. And every halving, we add a zero. We get 10 times bigger as a network. So we went from 10 to 100, 100 to 1,000, 1,000 to 10,000, 10,000 to 100,000 this time, and next one will be 1 million. So that's coming. So I'm bullish. And I think, we'll be many millions as we get to 10 trillion of market cap. But I'm sorry, no, not many millions, but we'll be 500K. So that's my base case. That's my base case. But the price of gold will continue to appreciate as we print more fiat. So that number is not static, right? So 1 million, I think, is highly likely at the next halving. And the value of gold will continue to go up. So that's my base case. But as bullish as I am, and I've been bullish a long time, there's a guy you should interview sometime named Murray Stahl. Murray runs a firm called Horizon Kinetics in New York. Old school. He's even older than me, right? And I'm old. He's even older. And he was even earlier than me. And he makes me sound like a bear. He's like, no, Mark, you don't understand. This is the apex technology that will prove reverse Gresham's law. Throughout the history of mankind, Gresham's law has applied. Bad money crowds out good. In every shitty country you can think of, the bad money becomes worthless and crowds out all the good money. From Venezuela bolivars to Turkish lira right now, in real time. Bad money crowds out, and it's called Gresham's law. What Murray argues is reverse Gresham's law applies for the first time, and good money is going to crowd out all the bad. So he says, you're 10 trillion? Yeah, that's a given. We're going all the way, all fiat, which is right around 100 trillion. So that's guaranteed. And there's I actually tweeted this out the other day. I said it's the perfect image. And it's a big triangle on the top and a little triangle on the bottom. This is Bitcoin, this is fiat. And that's exactly what's happening. There's all that gravity is going to push that bad money. And this little triangle is going to become all money. And maybe it's pyramid, that makes sense. Put an all-seeing eye in it and it would be perfect.
Yeah. We have an audience who we have some pretty hardcore Bitcoiners, and then we have some people who are quite new to it. If there's one book on Bitcoin to get so people can understand on a more deeper level of how it functions, why it's elegant.
I'll give you two.
Great. Perfect.
One is fun and it's an easy read. You can literally read it in one weekend and it's great. And Ben Mesrick is an amazing writer. which is, Bitcoin Billionaires, story about the Lincoln Boss twins.
Yeah.
Because what's cool about that is it doesn't dive into the tech, and it's a story of how they got conviction. And it's just a great read, super easy, super fun.
Yeah.
The other is the Bitcoin Standard, and Safe Bean is amazing. I mean, there are a lot of good books out there. I mean, The Big Print, New by Larry Lepard, who's a friend of mine, is a great book. But the Bitcoin Standard is kind of like, it's a little dense, but it describes what we've been talking about, which is that this is a new monetary system. Look, there's a reason Warren Buffett hates it. There's a reason Jamie Dimon hates it. They have to hate it, right? Horse and buggy people hated horseless carriages. Train companies hated airlines. People who sell us crappy food filled with seed oils don't like steak. I mean, come on. Warren Buffett, 46% was financial services. He doesn't want you to own this. Right. Jamie Dimon, 100% is financial services. He doesn't want you to own this. So at the end of the day, 839 years, the banking industry, insurance, brokerage, title, it's a great run. It's over. Now, it's not over tomorrow. It's not over next week or next month, but it's over. And incrementally, bit by bit, that big orange Pac-Man is going to eat everything. And that's good. People say, well, you're not a real Bitcoiner if you don't put 100% in. Like, shut the hell up.
Yeah.
Okay? You don't live in Bitcoin. I mean, Steak and Shake now accepts it, but most people don't take it. It's still clunky. It's still hard to, do your own custody. Bottom line, it's your savings technology. It's your running money. So you put 2, 5, 8, 10, the younger you are, the bigger the number, away in cold storage, chill, and live your life. And then as you get wealthier, okay, you add more to it. But the stuff that you need to pay day to day, like I don't pay in Bitcoin, I pay in fiat. And I don't hold the fiat long enough for it to devalue. I get it and I spend it. And anything I have to save, I turn into Bitcoin or Bitcoin treasury companies or other things like that. And so, or venture capital. I like to invest in venture capital. So that's the other one.
Does Bitcoin eventually eat all other crypto?
Yes and no. I mean, yes, in the sense that no other crypto will take a role in money, none. But that doesn't mean that we can't have other digital assets or other blockchains that have value to do other things. Right. Smart contracts are a good thing. I mean, there's some things that have to get worked out, but they are a good thing. DEXs are a good thing. One of the challenges is, I say it all the time, is if ETH was created today, would anybody use it? When you could use Sui or Solana. I don't know. But the fact is, it wasn't invented today. It was invented first, so it has critical mass. There's more development on that. Does that mean it's going to go away, or is it going to go to 10,000? I don't really know. So it's not my preferred, and I'm going to leave you with this. So if you think about Web 1, Web 2, simple, 5 protocols, where there were 80, we end up with 5. TCP/IP at the base, we're using it right now, voice over IP. Then you got FTP to move files. You got SMTP to do email. You got HTTPS for websites, and ties it all together. Web 1, Web 2. Web 3. Okay, how's that going to look? Well, Bitcoin, base layer. Yeah, like it, good. Filecoin, kind of like FTP, files. Okay, good. Okay, Ethereum, kind of like the toolkit, www. All right, like it. No SMTP, no HTTPS. Breaks down. Is that Polkadot? Is it Cosmos? Is it Solana? Is it Sui? Okay, that doesn't really work. Okay, well, what about all the L1s? We're going to have a new system and bridges across all the L1s. The bridges suck, technical term. That's where all the hacks are. And, the Chainlink guys are, no, we fixed that. And I'm like,
right.
Kinda. So a world of L1s and interoperability, I like it. Hasn't been proven to work. So then I go to, the Sauron, one chain to rule all chains, the Lord of the Rings. It's just Bitcoin. And we build L2s and L3s and L4s, similar to, we got gold at the base layer. Then we got Fedwire. Then we got ACH. Then we got Visa and MasterCard. I don't ever use money. Here's a little plastic card, and I charge. And once a month, I settled ACH that settles to Fedwire. I never touch gold. So I don't really know yet. But most of the meme coins, they're going to zero. I mean, there's no intrinsic value. They're fun, and they're monetizing attention. Fine. And you want to speculate on that? Knock yourself out. Most of those will go to zero. That's like pre-seed stage venture.
Yeah,
Most
exactly.
of them go to zero.
Yeah.
But the ones that don't, I mean, maybe there'll always be a place. I mean, is NVIDIA stock at these levels any different than a meme coin?
Valid.
Not really.
Valid.
Not really. You can't justify the valuation based on cash flows.
Yep.
Tesla, same thing. Is it a good company? Sure. Is the value of that company less if you liquidated it? Yes. So what's the rest? Memishness.
Yeah.
That's fine. That's fine. Supply and demand. Is there going to be a change? And look, my generation, the boomers, we create a very cool system. We created this thing called 401ks, and we all put money in and we pump up the stocks. And then at some point, we're going to have to drain it, right? Self-fulfilling prophecy. It's capitalization weighted. The more you put in, the higher it goes. The more you put in, the higher it goes, and it's self-fulfilling. Well, at some point, when we start drawing out, which is going to start happening pretty soon, you start taking $1 trillion a year out, then it's less good. Same thing with real estate. We pump up real estate prices, and then suddenly all of us need to downsize. Who's going to buy all the McMansions?
Yep.
I don't know. I mean, not at the price they're listed. I mean, there's a house down the street from me in Chapel Hill. It's been on the market for almost 2 years.
Wow.
Priced at, $1.8 million because they're anchored to 2 years ago. And even 2 years ago, that was a dumb price.
Right.
It's a perfectly nice house, but it's probably a $900,000 house. Maybe you could get to $1 million if you ignored the fact that it's too close to the street and the yard's small. But it ain't worth 1.8, but they're not budging. And
Crazy.
in that bid-ask spread isn't reflected in the real estate numbers yet, but it will be.
Yeah.
And we haven't even started the exodus because we're living longer, we're healthier, and people aren't going to the old age homes as fast as they used to. All of my grandparents passed before they were 70. I just turned 62. So it's like, but my 3 out of 4 parents are all in their late 80s. So we feel good. But
Good.
And we're only here for a certain amount of time, but the idea that a self-perpetuating game can go on forever, just doesn't work.
Absolute pleasure, man. Before you go, where can our viewers find you online?
Yeah, I'm easy to find. I'm at Mark Yusko, MarkYusko on Twitter. I'm not as active as I used to be because my wife yelled at me because I was on too much, but I'm still active. And Morgan Creek CAP.com is our website. I've done, lots of podcasts. We do a weekly podcast called Digital Currents where we riff about A, B, C, D, AI, blockchain, chips, and data. I do an occasional one called Around the World. We have a YouTube channel called Around the World with Yusko. I just did 4 episodes, monthly episodes on tariffs, and I'm so done with tariffs. It was interesting. It was fascinating.
Awesome, Mark. Well, thank you so much for the conversation today, man. This was super enjoyable. I know your time is valuable, and I really appreciate you coming on.
No, thanks for the invite. Appreciate all the kind words. I hope this was helpful to people. And if people have questions, I'm easy to find, and I'm sure we'll do it again sometime.